Hi, this is Rene Jarquin, CIO at Single Point Partners. We're happy to distribute out the Q4 performance numbers. Obviously, everybody that's going through the review of these documents are seeing how difficult of a market we experienced in Q4. And in December in particular, we went through a 3-week period there of relentless selling, very painful, very difficult moments to watch our portfolios erode in value in the way that they did. The headlines at the time were relentlessly negative around the issues of the day. China and the US, the rate of rate hikes by the Fed. Nevertheless, during those very difficult moments, as you may recall, in my last market update I believe it was December 22nd, we recommended that we stay the course, that this was a moment of selling based upon panic, based upon sentiment and emotion, rather than on fundamentals, rather than on a sober look at the profit-making potential of the companies that we invest our clients' monies into. And we feel very good that through that very difficult quarter, we stayed the course. And in fact, in many cases, we rebalanced up to our target weighting for equity. So again, want to take this opportunity just to underline how important it is to keep our gaze on the long run here and not be distracted by noise and a lot of these geopolitical headlines that were shaking the markets. I want to also take this opportunity to underscore the importance of having core bond allocations in our client portfolios. That part of the strategy worked exactly as intended, which is to say that in the midst of the sell-off, our bonds were actually slightly up and holding value very well, which is exactly what we want them to do. So with those two highlights around some of the decisions that were made during that very difficult fourth quarter, let me switch to what we think will be some of the key issues for 2019. And I would say that the risks that the market was over-magnifying in Q4 around the China-US trade fight and around the Fed's rate of change with respect to interest rates, those risks haven't gone away, but I think they've been placed in the appropriate focus and perspective. And certainly in the case of the China-US tension, we don't make an assumption that those will be resolved anytime soon. We think those would potentially be ongoing headlines that could introduce volatility again into the equation. Certainly can't rule that out. But in an economy as large as the US, even a negative outcome in those trade negotiations is unlikely to tip us into a recession in 2019. And that's an important underlying assumption here. I would say the second thing that's an important viewpoint of ours going forward is the Fed has, without a doubt, pulled back on their forward guidance with respect to interest rate hikes in 2019. 4 months ago, the markets were pricing in another 1 percentage points worth of rate hikes in 2019. Today, that number is probably closer to 0 or 1/4%. And though those numbers may sound small to us, in fact, those are pretty significant moves in the bond markets and could also be a source of volatility in 2019. But we feel pretty good that the inflation rate in the economy is contained. And by the way, that is the key determinant that the Fed uses as a guide of how quickly to raise interest rates. So if inflation is contained, we feel pretty good that the Fed has the ability to be patient in raising rates further. So with that said, we feel very good about how our clients' portfolios are positioned going into 2019. and certainly look forward to answering any questions you may have specifically about your portfolio in the coming months. Thank you.